So the problem that you have, if you're a person of wealth, you've got assets. And wealth doesn't need to be big wealth. It could be just moderate. The problem that you still have is that HMRC will come along and try and take it away from you. And the purpose of this video is trying to explain different models that you can use so that you can keep the money yourself. And when you want to pass it down to your children, you equally don't have to suffer all the tax liabilities that you could currently face. My name is Simon Mishevich. I'm from Optimised Accountants, and we help property investors, landlords to help them reduce tax now and in the future. And there's our website if you want to go and check us out. I have created a property tax book which you can download for free using that QR code shown on your screen. So the tax changes affecting your wealth, and this is really a look back of what's happened. Obviously, the Section 24 mortgage interest relief cap meant that you could not offset mortgage interest costs against your rental income. And some of my clients, which are paying a lot of tax, but some of them are actually paying up to 135% in tax. Honestly, that means that they're paying more tax than the profit they made. And I just think that's just wrong. Second change that we saw recently is that furnished holiday lets, which used to have the Section 24 removed, is now not going to be having that ability. From April 2025, you cannot offset mortgage interest costs against the rental income. So that's a bigger problem as well. And then you've got now the stamp duty to land tax, 5% additional higher rate, which used to be 3%. So another attack on landlords. And finally, inheritance tax. If you have got pensions, then that will be subject to inheritance tax. So not only will your property portfolio be subject to inheritance tax, even maybe not before, but when you add on your pensions from April 2027, pretty much everything could be subject to inheritance tax. And that's no joke. I did a video on that to show that tax could be 87% on UK pensions. So here's an example. Consider Sarah, a 50-year-old landlord with large property portfolio. After tax changes, her liabilities have doubled because of everything I've just described. With expert advice, our expert advice, she took advantage of the tax saving strategies and reducing her tax burden significantly. You can do this too. And when I talk about you have to spend lots of time with us, we can do 1-hour tax consultations, which last you for 5 years or even more. Tax mitigation models. These are the things that can help you to reduce income tax as well as inheritance tax. Using limited companies. Now, limited companies isn't for everyone. So before you jump into any of these models, make sure you do get some tax advice. I do see people setting up limited companies needlessly. They don't need it. They could have kept their assets in their own name and not pay as much tax and have all the accountancy fees that go along with it. Now, it can help you reduce income tax, and it can also help you to reduce inheritance tax as well, if you use it wisely. Gifts and trusts can help you to reduce inheritance tax. A use of trust also gives you asset protection. Use SIPs for commercial property investing. SIPs is a good way to also loan money to your limited companies for you to do developments. So really accelerating the growth of your SIP so that you can make more of your wealth. Another one is buy commercial properties. Now, there are two aspects to this. You can keep commercial properties because commercial property doesn't have the burden of Section 24 mortgage interest relief cap. But some people will try and buy commercial property and then convert it into residential. And why would they do that? Well, simply because they can reduce their stamp duty land tax and they do not have to pay this new 5% higher rate when buying commercial property compared to residential property, saving a lot of tax. Divide assets between spouses. A lot of things that I talk with clients is that we've got a high rate taxpayer and still all of the bank accounts or the shares are all in their name and they're paying more tax needlessly because the basic rate taxpayer could have had those shares, could have had those other forms of income, reducing 20% tax. Leave the UK. Now, I know a lot of my videos have been talking about this at length, but leaving the UK could well be a good strategy for you to take on board and reduce your taxes. So my name is Simon Mishevich from Optimised Accountants. Hopefully that video has been useful. You can check out our website, but I do recommend you watching the video talking about 87% on UK pensions from April 2027 if you haven't already watched it.